This guy just signed his mortgage and the rate is way higher than he expected. He asks why. The loan officer just shrugs. Blame the market, he says, but it's not really the housing market. It's not even the stock market. It's a $145 trillion market that almost nobody talks about. The bond market, bigger than the entire stock market, dwarfing it completely. $145 trillion. Let that number sink in. Bigger than stocks, bigger than almost anything you can picture, bigger than the entire U.S. national debt market on its own, bigger than the GDP of most countries combined. But somehow nobody talks about it. By the end of this video, you'll understand exactly why. Quick favor before we dive in. If you're new here, hit subscribe so you don't miss the next one. Let's break it down from the very beginning. Here's what a bond actually is. Strip away the jargon, and a bond is just an IOU. Someone needs money. You lend it to them. They promise to pay you back plus interest. On a set schedule, you collect interest payments until the bond matures and you get your original money back. Governments, companies, even cities all do this. Governments borrow to fund roads, schools, the military. Companies borrow to build factories or expand. Government bonds are generally safer. Corporate bonds can pay more, but they carry more risk. At the riskiest end, you've got junk bonds. Higher yield, but a real risk of default. Higher reward almost always comes with higher risk. You don't have to hold a bond until it matures. You can sell it. There's an entire marketplace just for trading bonds. In fact, more money changes hands in the bond market every single day than in the stock market, by a wide margin. Here's where it gets interesting. When rates go up, watch what happens to your bond. Your old bond suddenly shrinks in value next to the new ones. Think of it like trying to resell last year's phone next to the newest model. When interest rates go up, bond prices go down. They always move in opposite directions. Why? Because nobody wants your old bond paying 2% when brand new bonds are paying 5%. So the price has to drop to stay competitive. Your $1,000 bond might now only be worth $700. Flip it around. If rates fall instead, your old bond suddenly looks amazing. That old 5% bond feels smug. The new 2% bond, not so much. This isn't just abstract math, it ripples through everything, including your mortgage. We'll get there. Banks hold massive amounts of bonds, and when bond prices crash, bank balance sheets can crash with them. This has actually happened. Real bank failures, triggered this way. More on that later. There's also something called duration. Basically, how sensitive a bond's price is to rate changes. The longer the bond, the bigger the swings. A 30-year bond can feel like a roller coaster. A 1-year bond barely moves at all. Rates up, bond prices down, always opposite. Most people believe the Fed hikes rates, so mortgages follow. It's not wrong exactly, but it's not the full picture either. The Fed directly controls short-term interest rates. That's it. Mortgage rates are tied to long-term bond yields, and the Fed doesn't directly set those. Fed policy influences expectations. Expectations move the bond market. Investors are constantly trying to predict future inflation. If they think inflation will eat into their returns, they demand a higher yield to make up for it. That fear can trigger a bond sell-off, pushing yields even higher. Inflation expectations move bond yields more than the Fed does. History backs this up. There have been stretches where the Fed cut rates and mortgage rates actually rose, and stretches where the Fed hiked and mortgage rates barely moved. If mortgage rates simply tracked the Fed, that couldn't happen. Banks take that 10-year yield and add their own spread on top, covering their own costs and lending risk. And that's roughly how your mortgage rate gets built. The 10-year Treasury sits quietly behind almost every mortgage in the country. It connects straight through to your mortgage rate. Most people have never even heard of the 10-year Treasury. Fed policy, then the bond market, then your mortgage rate, in that order. So, let's talk about what happens when this market panics. Normally, long-term rates pay more than short-term rates, but sometimes that curve flips, and that's a major warning sign. This inversion has preceded most recessions for decades. When investors expect future rate cuts, it usually means they expect economic trouble ahead. Markets can move fast and fear spreads quickly. We've seen real bond market panics trigger actual bank runs. Pension funds get hit hard too when bond values fall. A foreign government's bond market has crashed almost overnight before, sparking a currency and pension crisis. Central banks had to step in urgently just to stabilize the panic. In some cases, a government official has resigned after the bond market essentially rejected their budget plan. The bond market can be bigger than any single president, prime minister, or central bank. And it matters even more given the size of government debt today. Every year, more of the national budget goes just toward paying interest. That slice of the budget keeps growing. Eventually, it can show up as credit downgrades, bigger deficits, and tougher borrowing conditions for everyone. Some buyers start backing away from the debt altogether. Banks, pension funds, and foreign countries are the usual buyers. Borrowing costs keep climbing under the weight of it all. More debt leads to higher rates, which leads to even more interest owed. It's a cycle. And sudden policy shifts can rattle this entire market overnight. Okay, so what do you actually do with all of this? First, understanding this chain helps you make smarter decisions about locking in a mortgage rate instead of just hoping for the best. Second, know the difference between owning a single bond versus a bond fund. Hold a single bond to maturity, and your principal is guaranteed back. A bond fund never matures, so its value can keep swinging the whole time you own it. Third, look into short-term Treasury bills. They often pay more than a typical savings account, and the interest is usually exempt from state taxes. Fourth, if you're worried about inflation specifically, there are inflation-protected bonds that adjust their payout based on rising prices. That makes them especially useful during periods of high inflation when a regular bond's fixed payout can quietly lose the purchasing power year after year. And finally, match your bond's duration to when you'll actually need the money. Long duration bonds can be great for some goals, but reckless if you might need that cash soon and rates spike unexpectedly. This isn't about avoiding bonds, it's about understanding exactly what you're holding. So let's recap. Bonds move opposite to interest rates. The Fed doesn't directly set your mortgage rate. The bond market does, and matching your bond's duration to your actual timeline matters more than people realize. Quick disclaimer. I'm not a financial advisor. This isn't financial advice. I'm just trying to make this stuff make sense. If this helped, hit subscribe and let me know in the comments what part confused you most, because that helps me figure out what to cover next. See you in the next one.